You're weary, feeling small. When tears are in your eyes, I'll try to.
Gonna try.
Hi, Brian.
Hello, Chubby. Chubby? Is that what I call you?
Yes, yeah, correct.
Okay. Nice to
Okay,
meet you.
yeah, can you hold on for 1 minute? We need to have like 1 or 2 people join us from the group, so they are actually trying to get in. So I have to let them in. Can you just hang on for 1 minute?
Sure thing.
Okay, thank you. Okay, let me just start up. Maybe they'll catch up when I'm doing your introduction. Thank you guys for joining us. This is the World Hackers. The World Hackers is where we teach people how to invest their money and then not lose their money to the market. How to do this over time and not lose their money. We are interested in getting people the coaching they need. And we are concentrating in Africa so far, although we have other people joining us. Our aim so you don't lose your capital, because when you lose, can invest effectively and Brian is actually a long-term investor. He started investing he's been in the market, actually a contributor for he's actually a contributor for one of the big investment guys we know on the internet. So okay, the signal is breaking down. Okay, let me just switch and then add other people. Okay, Brian, can you hear me?
Yes.
Okay, some other guys are joining us. You said something about the signal. I'm just getting that fixed.
Yeah, the audio and the video was like choppy a little bit. So
okay, I guess it's the network, but can you hear me loud and clear right now?
Yes.
Okay. Okay, so I was actually introducing the platform, the World Hackers, and what we do and all that. Brian is actually an investor that started investing in 2004. He's been investing for a long time. He's actually a long-time investor. And I guess I'll leave the rest of introduction to Brian. So Brian, can we get to meet you? Can you just tell us a little bit about yourself, how you started investing, and how is it going so far?
Sure. Thank you, Chubby, for having me. I'm glad we could make this work. Fun to speak to somebody from Africa. This first interview I've done with that. That's awesome. So thank you for the invite. So yeah, my name is Brian Feroldi. I've been investing in the stock market for 17 years now, and I use the term investing a little bit loose because when I started investing in 2004, I didn't know anything, like zero. I knew nothing about the stock market. But at the time, that's right when I graduated college. And I started to, my father handed me a book called Rich Dad, Poor Dad, which was the first book that I ever read that introduced me to the concept of investing, and everybody's in business for themselves, and it's your responsibility to become wealthy. And that just kickstarted a absolute love of everything, a desire for me to learn everything I could about money, personal finance, and investing that I could. Through that time, I just read every book. I listened to every audiobook. I read every blog that I possibly could about investing. That eventually led me to The Motley Fool. I've been reading stuff from The Motley Fool for over 15 years now. I was a happy subscriber to The Motley Fool for many years, and just posted on their discussion boards constantly for years and years and years. And then about 5 years ago, I was afforded the opportunity to come and become a writer for them, which was like my dream job. So I took that job happily, and I've been doing that ever since. And the last 2 years or so, I've been far more active on Twitter than I ever have been in the past. And there I share all the lessons that I learned the hard way about investing with other people, so that they don't have to learn those lessons themselves.
Okay, thank you very much. That's an intriguing story. So let's just dive right into this. So how do you actually invest? Do you normally do you see yourself like a growth investor or value investor? Because we always having this time, a lot of people say I'm a growth investor, I'm a value investor. So what do you see yourself as?
Yeah, I understand why there's a distinction between those two, because historically those are the two camps that investors fall into. Are you the type of investor that's going after primarily growth strategies? You're willing to pay up to buy companies that are innovative but has a higher chance of failure. And if you can find that those few companies that go on to derive huge wealth creation, you can do very well. Or are you the type of investor that looks for analytical and buys things that are statistically cheap and then holds them until they're no longer statistically cheap? So those are the two paths that investors are primarily diced themselves up into. If I had to categorize myself in one, I would say that I skew more towards the growth investor side than I do the value investor side. But in general, if I had to break down my investing style, it would be I invest in the highest quality companies that I can find, period. I am constantly looking for high quality businesses that I believe are capable growing at an above average rate for years and years and years, or hopefully decades. And I try and find those companies. I scour the markets for those companies. I use a checklist that I have developed to test whether or not those companies are high quality. When I think I've found one that could be a long-term grower, I will scale into that company slowly over a period of quarters or years, and I will hold that company as long as it remains awesome. And if I'm occasionally right about the companies, those few companies that I've held that truly are the next great wealth creation machines will drag my entire portfolio higher over time. So that's roughly the strategy that I'm going for.
Okay, thank you. Then Warren Buffett, that you normally get.
Can you repeat that, Chubby? I didn't hear you.
At a particular Hello, Brian. Can you hear me?
Yep. Your audio is still a little choppy, but I can hear you. Or I heard you initially.
Mis-
Hello, Brian.
Hello?
Okay, sorry about the little internet connectivity problem. Can you hear me now?
Yes, much better.
Okay, thank you. Okay, Warren Buffett once said that as an investor, you can invest in 6 ideas, that most times your 7th idea becomes the mistake. So how many stocks do you keep in your portfolio, and what's the yardstick for picking these stocks?
I missed the last question there, but I got how many stocks do I keep in my portfolio?
Yeah, and what's the criteria for the number? How many? What's the criteria for the number that you pick?
Sure. So I currently own, I don't have the exact number in front of me, but somewhere around 65, 70 stocks myself. And if you hear that, you might think, why bother? That's so many. How can you beat the market with that many stocks? So I think that I actually know that there's been plenty of investors who historically have kept their portfolios extremely diversified and yet have still gone on to thump the market. Peter Lynch comes to mind. Shelby Davis comes to mind. Both of them own hundreds, if not thousands, of stocks, and they still manage to thump the market over time. Some investors say, I only want to run a concentrated portfolio. I want to hold 5 stocks or 10 stocks at maximum. To which I say, to each his own. Do whatever you want. My personal style is to is the way that I position sizes in my portfolio. I am happy to own lots and lots and lots of stocks because of what I said earlier. Owning a small minority of stocks that are on the market will actually drive the vast majority of the market's returns over time. So it's really important that you find and own at least a couple of those mega winners. The way that I find those the way that I think I maximize my chance of owning those mega winners is by buying small positions in lots of stocks over time. And if that increases my chances of getting those few wealth creation compounding machines into my portfolio. And importantly, the way that I build positions over time is to add to my best performing stocks over time. So when I'm looking to deploy new capital, one of the things that I do is I look at my portfolio and I say, what's winning? what stocks are doing well, what businesses are adding new customers rapidly, are taking market share, are growing revenue, are expanding their margins, are adding new opportunities to their future growth. Those companies, those winners, I will then continually buy over and over and over again. And the companies that are losing in my portfolio, the ones that I have less confidence in over time, I just ignore and I just kind of let them fade away into obscurity. So if you look at my portfolio today, my top 10 positions are somewhere around 50 or 60% of my portfolio. So even though I own almost 70 stocks, my bottom 30 stocks are probably 5 or 10%, and my top 10, like I said, are 50 or 60%. However, I didn't pick my top stocks. Those companies earned their top spot in my portfolio by being tremendous performers. I bought those stocks slowly years ago, and it just turns out that I was right about them. One of my biggest holdings today is Tesla. Tesla is maybe like 8 or 9% of my portfolio. It depends on the day. But I didn't set out to make Tesla an 8 or 9% position for me. I bought Tesla in 2012 and just never sold it. And I added slowly along the way. So the reason that Tesla became such a big position for me is because the stock is up almost 100-fold from my initial purchase price. The same thing is true with my number 2 holding, my number 3 holding, and my number 4 holding. So my portfolio, the way that I structure my portfolio, is to place lots of small bets, add to my winning positions over times, and then do my best to not sell my best performers. Doing so basically gradually concentrates my portfolio over time, and I gradually become more concentrated into the best performing stocks that I have. So that's how I approach the diversification to concentration strategy, is I let the market do the concentrating for me.
Okay, that poses the next question. Do you ever sell? And if you sell, what is the top 3 criteria you use when you're deciding that you want to sell? Do you ever sell these multi-baggers?
Yes, I do. I do sell. In general, all of the worst investing mistakes I've ever made all contain the word sell. So the worst, the most expensive in financial decisions I've ever made were to sell great companies early. I sold a company called Dexcom. The ticker symbol there is DXCM for $7 back in 2007. I bought it for 6 something. I sold it for 7 something a few weeks later. Dexcom is currently trading for $420. That I sold a company 60. I sold something that went on to 60x in value. So because of that and many other selling decisions that I've made, I have learned the hard way that you should be highly reluctant to sell great companies. But there are reasons that I will sell. You asked for 3. I have 11, but I'll cover my 3 main ones. The number one reason I sell is I was wrong. I made a mistake. I had a thesis for a company. This company is going to grow because of A, B, C, D reasons, and time shows that A, B, C, D reasons are incorrect. So I made an assessment about the company's brand, about the company's management team, about the company's moat, about the company's financial situation, and I proved to be wrong about that. For example, several years ago, I was really bullish on a company called TripAdvisor. Ticker symbol there is TRIP. They had a massive network of online reviews, and they had huge influence, and still do today, over decisions that are made for travel. So if you want to stay at a hotel or go to a resort, there's a really good chance that you are going to be using TripAdvisor to make that decision. Because of that, I said this company is in a fantastic position to monetize itself over time and should continually grow and grow and grow for years. Turns out that was wrong. The company has struggled mightily to grow over the last 5 years, and its stock has really suffered. Therefore, I was wrong about my assessment of TripAdvisor. So I sold TripAdvisor because my original thesis for owning the stock was proven wrong. Another company that I was wrong about recently was Grubhub, which is a meal delivery service in the United States. Grubhub was one of the top apps that you could download to have food from a restaurant delivered to you. And I thought that they were, well, my logic was, well, if you are a consumer, which app do you want to use? The one with the most choices. If you are a restaurant, which app do you want to use? The one with the most consumers. I thought that Grubhub had an unassailable moat, that they're in a very, very strong competitive position. Turns out that that was wrong. Some other companies such as Uber Eats and Postmates have taken market share away from Grubhub, and the company's financial results really deteriorated as a result. So those are two companies that I was formerly bullish on, that I own positions in, that I since sold out of because time proved me wrong. So that's the number one reason I sell, is my original thesis for owning this stock was wrong. And that's the most common reason. Number two, the number two reason is the something changes with the company's corporate culture or the management team. A CEO transition could be a really tricky thing for a company to pull off. Starbucks is a fantastic company, has been for years. When Howard Schultz left the first time, the company's leadership team, there was a vacuum, there was a void there, and Starbucks really struggled without Howard Schultz there, and he actually had to come back in to kind of save the company. So if the CEO suddenly leaves, especially if that's the founder of the CEO, or their company is a mass exodus amongst like its management team, that's a sign that business is in crisis, and that can be a good reason to leave. Finally, the number three reasons that I sell is I want the money for my personal life. I want to do a home renovation or buy a car or go on vacation, AKA the reason we invest in the first place is to grow our wealth so that we can live a better life. And if there's some expense that I have that I want to pay for with my stock market gains, I will sell to fund that expense. But there's top three reasons.
Okay, do you ever sell because of the allocation? Do you do stock allocation? Do you allocate certain amounts to some particular stocks? And do you ever sell a stock because it's getting too big?
Yes. I will sell a position if it does get too big, and too big means different things to different people. So my rough rules of thumb are if a company is amazing and low risk, I will let it become a 15% position for me, like Amazon. Amazon is an amazing business that's pretty low risk. So I will let that become a 15% position for me. If it's an amazing business that's high risk, such as like Tesla is still a pretty high risk company. But it's done amazingly well. If that position became a 10% for me, that would probably be a little bit too high for me. So I would see myself trimming those companies. But I also know some other investors that say, I'm happy to have my number one position be 80% of my portfolio. They're just very comfortable with this company is doing such good things and it's winning so well that they're happy to let it become and dominate the vast majority of their wealth. I don't think that there's any right or wrong reason. There's any right or wrong strategy there, but that's the template that I have for myself so far.
Okay. Do you keep cash as part of your portfolio? And if you do, what percentage of cash do you normally keep in your portfolio?
Yes, I do. First off, I always keep an emergency fund, not in the market. That for me would be 6 months worth of family living expenses that there's nothing but sit there and make me happy that it's there. I realize it's losing purchasing power and it's losing to inflation and all that kind of stuff, but I don't care. The job of that money is not to make me wealthy. It's to keep me from needing, in case of financial disaster, I have that to lean back on. So aside from that, I do keep cash in my brokerage account that I can use to deploy for opportunities. It generally ranges between 1% and 5%, depending on what opportunities I see or what the current market conditions are. Currently, my cash is about 3% of my portfolio. So I do see some opportunities for investment out there, but I don't think like right now it's like it's not like the market is extremely on sale. So I am being more picky with my investments today than I was, say, in like March of 2020. But yes, I do generally keep a cash cushion.
Okay, I wanted to keep the question to the end of the section, but it's just about what we're talking about. So let me just go ahead and throw the question. It's from one of our people. He asked, when you are buying a lot of stocks, are you not spreading yourself too thin? And then how do you keep track? Do you have a formula or a way to keep track of all the stocks that you're buying?
Yep. So I keep track of everything in a spreadsheet that I have. And my secret for keeping track of so many things, there's two. One, I'm an investor, which means I buy and I own these things for years. So I don't sweat every market move that these things make. I get messages all day on Twitter about, what about ABC stock? It's up or down 5% today. What happened?
Yeah.
My answer is always, I don't know. I'm not paying attention to what's happening to these stocks today. I care about where these businesses are going to be 5 and 10 years from now. So all the work that I do up front to make sure that I put my capital into good companies, I can really take a hands-off approach to the stocks. So I typically pay attention to my companies around earnings time. That is the story that I'm looking for. That to me is the signal that I'm looking for. And that comes around once every 90 days. I mean, there are times when there's thesis changing news in between the quarter, but typically I'm looking for earnings reports and I want to know, is revenue up? Profits up, any new business units, those kind of things can be ascertained relatively quickly. So a big, even though I have a lot of positions, I'm not looking at all of them every single day. I'm tracking each of them throughout the year. The other thing, number two there is if I am opening up a position in a brand new company, I go in very small bites. So 0.5% of my portfolio. So 1/200th of my portfolio value is what I'm buying at any given time. The reason I do that is because of this quote that I absolutely love from one of my favorite investors of all time named Tom Engel. He says, if this stock is the next great growth stock, a little is all I need. If it's not, a little is all I want. So if I made a mistake with a company or purchase, it's almost it's a rounding error when compared to the rest of my portfolio. So because of that, I don't have to pay extreme close attention to my smaller position. Third, I'm a happy member of the Motley Fool, and I rely heavily on the Motley Fool to help me keep track of my portfolios. And just by perusing Twitter and connecting with other fools, whenever there's like a news story that is actually going to impact one of my holdings, that news will get to me. So it is a combination of investing for the long term, position sizing, and help of the community.
All right, thank you very much. So let me just quickly talk about economies. Do you invest in emerging communities like in Nigeria, South Africa? We do have some stocks listed on the New York Stock Exchange and NASDAQ. So I don't know, you know about Jumia, at least that's one popular one that went, I think last year it went viral. It's actually mainly from Nigeria. So do you look at some of these stocks and do you concentrate in economies or do you just look solely on the business?
So to answer your question, I am not specifically setting out to say, I have to have capital allocated to Africa. I have to have capital allocated to South America. I have to have capital allocated to ABC region. I want my capital in the best companies that I can find, period. That's where I put my capital. I will say my number one or my number two holding is Mercado Libre, which is ticker symbol MELI. They are the leading e-commerce platform in Latin America. So that is my number one position. So the reason I own Mercado Libre is because it's an amazing business. It's founder led. It has done phenomenally well for investors since it listed on the NASDAQ. The other thing when it comes to international diversification is it's important to understand what that is. I don't care so much where a company is headquartered. I care where it gets its revenue from. I care where its customers are. So take a company like Apple. Apple is headquartered in California, Well, what's the company's? I think the company's biggest individual market opportunity is China. So is Apple a Chinese company? No, but that is where its growth is coming from in the Asia Pacific. In fact, I think a minority of the company's revenue is actually derived from North America. So that is an American listed company that's based in California, but you can argue Apple is an international company. The same with Microsoft, the same with Starbucks, the same with Nike, same with a lot of businesses. So the combination of owning companies that are internationally diversified, I think gives me exposure to international markets, but I'm happy to look at any company and will judge it the same way I judge every other company, which is this awesome? If so, I want to own it. If it's not, I don't.
Okay, you mentioned something, and I've been meaning to ask you this question for a long time. Now, you mentioned something about founder-led. So do you think that companies that actually have their founders still leading the management team do have a little edge over the regular companies that just have new executives that were not part of the founding team?
Excellent question. And I think the answer there is yes. And a huge yes. And there's actually studies out there that show that founder-led management teams, founder-led businesses outperform non-founder-led businesses. I think there's a couple of reasons why that is the case. And the number one is the most important. If you found a business, getting a business off the ground is a tremendous amount of work. I mean, it is like raising a kid amount of work. You have to put so much of your career capital in that, so much of your time, so much of your energy into that. It takes a very unique individual to do that and to birth a company and to get it to be successful. If a founder does that and gets all the way to being a publicly traded company, it's almost impossible for that founder to not be ridiculously wealthy. Like that founder could hang up their spurs, stop running that company and retire. Like they are going to be incredibly wealthy at that point. Yet, the founders that stick around and choose to go through the hard work of running a public company at that point, why are they doing that? They're already rich. Like they're not doing it. They're not running that company for the money. They're doing it because they themselves believe intensely in the opportunity ahead of that company, and they enjoy running it. They're not the CEO solely for the payday. They're the CEO for other reasons. So I think that's one, is that they have soul in the game. They deeply care about the long-term health and viability of that company. Number two, I think that Wall Street gives founder-led CEOs who were clearly right about some business opportunity more latitude than they give CEOs that are not founder-led. If I became the CEO of like Ford Motor Company, for example, you can bet I'd be on the hot seat every quarter to deliver revenue and earnings targets that makes them happy. If Henry Ford was still running Ford Motor Company and he said, to hell with this, we're investing for the long term, I think Wall Street would be more willing to give him latitude since he was the person that founded the company. And then three, founder-led businesses, founder and entrepreneur CEOs they're still running their company are clearly adept people at spotting market opportunities and then investing to take advantage of those market opportunities. That's how they founded the company in the first place. So they have the cachet within their own organization to say, here's an opportunity, we are going to go after it. And getting their company on board to go after that opportunity is something that they can do because they have a proven track record of saying, I founded this company. Look how well it's doing. I think this is an opportunity, and shareholders, suppliers, employees can kind of believe in that founder. So when you mix those things together, I understand why founder-led businesses tend to outperform non-founder-led businesses. So if you look at my portfolio, many of the companies that I own are led by their founders. It's not a guarantee, of course. There are plenty of founders that take their company public and then screw things up because, again, hey, they're rich, right? If the company goes down 80%, they're still rich. So some founders view their CEOs as somebody to take advantage of. Others view them as partners. But overall, I would much rather have a portfolio filled with founder-led businesses than not.
Okay, then two quick ones. It's just to follow up. Now, when the founder has passed on and the generation, the second, third, fourth generation are actually the people managing the business, do you still count it as a founder-led business? And the second part is, what do you really think about the insider trading in a company, top management always buying and selling and all that? Do you think that's part of what someone should consider when making a thesis and fundamental analysis?
Sure. So question one was founders' kids take over, and question two was, do I consider, what do I think of insider buying and selling? Okay, I'll take them one at a time. So all things equal, if a founder run the business and then they kind of handed it off to their kids, I'm skeptical. I'm pretty skeptical because the founder, again, has spent a tremendous amount of time on the business. And a lot of times that can come at the expense of their family. And a founder's son or daughter that's taking over, they haven't proven anything to me. They haven't proven anything to me. They haven't done anything except we're lucky enough to be this person's son or daughter. So if that was the case, I would seriously wonder about that company. Now, there are instances of children taking over businesses and the children actually running the business better than their parents ever could. But overall, I would be skeptical of that happening. I can't even name a single company in my portfolio where that's the case. But if that was to happen, I would be very skeptical and say, prove to me that you are capable of running this business. I don't care who your dad was or who your mom was. I care about you and can you make good decisions? In regards to insider buying and selling, there are lots of sources on the internet that will track that kind of stuff very closely. And they'll set articles like Mark Zuckerberg just sold $500 million worth of Facebook stock. Should you be worried? In general, I pay very little attention to insider buying or selling. The reason I do that is because I myself worked at a company that was private and then became public. I can tell you that almost every executive at that company was selling along the way. Even if the majority of them believed in the long-term viability of the company, they simply desired liquidity. Imagine if you were the CEO of some company and you were given literally $10 million in options in one company. Do you really want 99% of your net worth invested in one company? I wouldn't. So I would be continually selling off my holdings in that company for risk management purposes. That doesn't mean that the company is going to fail. Again, the company that I worked for went public at about $15 per share. Insiders were selling the entire way, and that company is now worth $300 per share. So insiders sell for dozens of reasons. Because of that, I de-emphasize when I see a founder is selling. I would make an exception if a founder had like 30% of their, if they own 30% of the shares, and then the next year they owned 5% of their shares and they made some significant sell. But if they are constantly trimming a small bit of their portfolio, I'm okay with that. I still want to know, is this business great? And are the results tracking as I expect them to? That's what I pay attention to.
All right, thank you. So the next thing I want to ask is, when I know that you normally get your sources of information from the social media and the Monthly Fool or magazine, the question now is, how do you control FOMO and the noise that actually come from the social media and other ends like that? How do you control the noise? Because we know that whenever a stock is doing tremendously well, even if you check on Google, you discover that there's a spike in the number of searches for those. Now, how do you see something that's going to affect the business, or even it's just something that's going around in the market that doesn't impact the business?
This is something you kind of have to learn over time as an investor. You have to learn as an investor to separate the signal, things that matter, from the noise, which is things that don't. And if you pay attention to the markets at all, if you're on social media at all, most things that are on there are noise. They are a complete distraction from the company. And it makes sense that there is an intense focus on the noise, because what is the thing that we as investors are shoved in our face every day? The stock price.
Yes.
That is the thing that gets tracked by the media. It's the thing that people want to talk about. It's the thing that people want to focus on. This stock is up or it's down 3, 4, 5%. What does it mean? What's it telling us? And there's all kinds of articles that you can read, or technical analysis that's out there, but saying, what does this mean? Almost all of that is complete noise. And you as an investor have to know why you own what you own. And if you know why you own things, you know what you should be paying attention to and what you should not be paying attention to. When I buy a business, the output that I am ultimately looking for is higher revenue, stable or rising margins, and higher profits. That's it. Those are the things that I am looking for over time. If I buy a company today and that company's revenue is 10 times higher in 10 years and its profits are 50 times higher in 10 years, or some combination of the two, I am pretty darn sure the price is going to be much higher in 10 or so years. So what are the inputs that go into making that company's revenue go up? And what are the risks that can prevent that company's revenue from going up? Those are the things that I pay attention to and factor in. Whether the price is up or down is irrelevant to me, because what the price does on any given day, week, month, or year can have nothing at all to do with the long-term health of a business. And I just know as an investor, because I've seen it happen plenty of times, you can buy a great business that is adding customers, that is growing its revenue, that is doing everything right, and its stock does nothing or goes down. But eventually, if that company continues to succeed, add new customers, and grow the way that it's supposed to, the market will eventually realize that and reward it. So there can just be these multi-year periods when the business fundamentals and the stock fundamentals just head in completely different directions. You just have to know that and accept that as an investor up front. Otherwise, you're going to be busy chasing the price movements that are out there, and it's very easy to get distracted. So I really try hard to pay attention to things that matter and ignore things that don't.
All right, thank you for that. Now, the quick question before I move into the next thing I want to ask is about, we have an argument, a kind of conversation going on, because in Africa, we have a lot of people that just joined the stock market. So they actually see it as something you just put in your money in a day. By the end of the day, you have 50% to go. So it's more like gambling, trading. Have you ever been a trader? And what do you think is like the end of the road for the traders and gamblers? Do they really make it in the industry? And like, if you were to give advice, because you're talking to a big community right now, what do you think is the best strategy to use in the market, on your own opinion?
Well, when I first started investing, and I'll use that in air quotes, I did the exact same thing. Literally the exact same thing. I was trying to find penny stocks that traded under $5 that I thought I could sell the next day, 2 days, week, or whatever at a higher price. I thought that's what investing was. So I completely understand why so many new investors are focused on that, because again, the only thing that we are taught about the stock market, if we're taught anything at all, is price. Price goes up and down. And you hear things like buy low, sell high. And it's natural to interpret that as buy at a low price, sell it later at a high price, and cross your fingers that it happens. If you view the stock market as a place to put your money to realize a 50% gain in a week or an hour or a short time, it's a big gambling machine. So it makes complete sense that that's how people approach it. And things like cryptocurrencies and their huge volatility only kind of add to that to that allure. So it's very, I completely understand why people are focused on that initially. The fundamental piece of education that they are missing, or that I myself learned over time, is how the stock market actually works, how price is related to the business over long periods of time. I have since learned that those short-term market movements are random. There's no predicting them, or at least I know for myself, I have no ability to predict what's going to happen in the market next. None. Zero. Like, I know for myself that I would be a terrible trader. I don't even try. The thing that I have learned, though, is that if a business succeeds, if the underlying company that is surrounding that ticker symbol succeeds, and by succeeds, I mean invests in itself, grows the number of customers that it have, grows the number of products and services that it has, increases its revenue, maintains or increases its margins, grows its profitability over time, you could be 100% sure that eventually that stock will go higher. There's a lot of things that can cause that not to work out. Capitalism is brutally competitive, and there are competitors out there that are trying to steal business from any given company. But I just know that if I buy great companies and hold them for long periods of time, that my wealth as a shareholder will compound for me. So that is why I focus all of my effort on making sure I am invested in the best things that I can find, and I just ignore the day-to-day. But you really have to internalize that as an investor, that you are buying businesses. You have to approach this the same way you would if you were buying an apartment building. If you were going out and you were going to buy a building and then you're going to rent out those rooms to people, well, what would you look for? You would say, oh, I want a good space, a good location. I want it to be near parks and places to work. I want it to be in a low crime area. I want to find tenants that have stable jobs, that can clearly afford my apartment, that are going to be there for a long period of time. You wouldn't say, I'm going to buy this apartment today and I'm going to try and sell it tomorrow for 10% more. Like, that would be complete speculation and complete gambling. So you have to own stocks the same way that you would own a business. That's the mindset you need to embody.
Okay, thank you. You've mentioned two other asset classes in your last reply. Talked about cryptocurrencies and real estate. So two quick questions. Firstly, do you own any real estate? Do you invest in real estate? Then secondly, cryptocurrencies, like they are going wild. Everybody's just talking about cryptocurrencies. It's in the news cycle now, and some big firms are going after it. You know about Tesla. They said they made $101 million in purchase. So what do you think is the future of Bitcoin? Are you actively buying any cryptocurrencies at the moment? So
the question for you was real estate and then cryptocurrencies?
Yes.
Right? Okay.
Yeah.
I do own my own home. So that's my real estate exposure. I do own one real estate investment trust that's publicly traded, but I've learned about myself that I am interested in growth-oriented stocks, and that is where the bulk of my capital is. When it comes to cryptocurrencies, I have been skeptical of cryptocurrencies for a long time, and I would say only within the last 6 months or a year have I gradually started to warm up to them. I do not own any cryptocurrencies yet, but one bias that I have is I live in the United States and we have the global reserve currency for the world. So it's really hard for me. It's been hard for me to understand and accept the value of cryptocurrencies that are out there, because I see them. It's easy to see them as basically a big Ponzi scheme or a bubble that's going to pop. I've since slowly changed my mind about that, because I just can't get this one question out of my head. Should there be a global currency of the internet? I think the answer is yes.
Yes.
I really do. Should there be
Yeah.
a global non-regulated currency of the internet? I think the answer is yes. Is that global currency going to be Bitcoin? I don't know. It's certainly the top dog and most likely currency as of right now. Whether it will be the ultimate winner, I don't know. I do think that the underlying technologies that enable cryptocurrencies, namely blockchain, that is a true technology, and I've come to really really appreciate that technology as a foundation. So I do not own any cryptocurrencies yet. I could see myself making them a part of my portfolio in the future. However, if I did that, I'm not going to go I'm not going to put 10% of my wealth or 20% of my wealth into cryptocurrencies. They would probably be a small piece of my portfolio. So I don't own any yet, but I could see myself owning them in the future.
Okay. Thank you, Didis. Let me just ask one follow-up question before we move to the next. I just wanted to get what you think about NFTs, Ethereum, the way they are revolutionizing the way we see our payment systems. You know about NFTs, non-fungible tokens?
Yes.
Yeah, I just want to get your thoughts on them and on the Ethereum for payment systems and all that. What do you think the future holds, just in a nutshell?
So NFTs, everything related to cryptocurrency that I've seen initially, I've been skeptical of. NFTs are the one thing that I got it immediately. I was like, oh, this is I think that the NFTs is using blockchain technology for something that I can understand, and I understand, and I just think to me the one-to-one relationship there is very easy to say. Why is the Mona Lisa valuable? Answer: because we all agree the Mona Lisa is valuable. And is there somebody out there that would pay $50 million to own the Mona Lisa, even though you could buy an exact replica of the Mona Lisa for $100? Yes. That concept is clearly established in humanity. So it does make sense to me that there should be a digital version of that thing. I was even explaining this to my wife. My wife's very skeptical of everything that's new. And I was trying to explain to her NFTs. And I was like, all right, what about if you could own Taylor Swift's Shake It Off? What about if you could be the digital owner of Taylor Swift's Shake It Off? Would you like to be? She'd say, yes. I say, that's NFTs. It would be everybody else in the world could listen to that song as much as they wanted. But when it came to saying who actually owns this, you would be the one that actually owns this. And she said, oh, okay. That to me is NFTs. So I have not purchased any NFTs myself. I'm actually interested. I'm going to be experimenting soon with creating them. I think there's a lot to be on the creator side, but that is a use of the blockchain that I believe in.
I think your tweets will sell for $1 million because you do have amazing tweets. If you had to tokenize those tweets, they will sell for a lot. Okay, let me just quickly go back to the stocks. Is there an industry that you're looking at the moment? Okay, is there one stock you're looking at? Let me go this way. One stock you're looking at the moment, you're saying, okay, this is being underlooked, that it has great potential. And is there any industry that you're looking at and you're saying, okay, this industry is going to define the next 10 years around the investing world?
Yeah, there's a lot. I mean, any given stock that I'm looking at any given time.
Yeah, we just need just one. Let's just get focused on your top, the one you like.
Sure. So I will throw out there. This is a company that I have recently became interested in. I'm getting feedback on something. I'll throw out there.
I think I just admitted someone. The person didn't mute his mic. Okay, sorry.
One company that I've been looking at very recently, and this company just came public on the U.S. markets about a week ago, is called KnowBe4, KNOWBE, and then the number 4. The ticker symbol there is KNBE. This is a software company that's focused on cybersecurity, but they're focused on it from a completely different way than other cybersecurity companies. This is a software platform that trains employees to have better digital hygiene, as they call it. So it's a software that trains people to not click on phishing emails, or have a good password program, or understand and get training on how they can keep their organization safe. Because as Nobefor points out, you could have the best cybersecurity in the world. If an employee makes their password 12345, or if they click on some email that gets through all of that, that can put the organization at risk. So they are focused on training employees to have better digital hygiene, to keep their company secure. This is a brand new company that just came public like 3 or 4 days ago, and it's about a $4 billion market cap. I am still researching this company and getting interested in it, but it is one that has caught my attention recently.
Then what of industries? We have a lot of industries that are actually disruptive at the moment. We talk about the AR, VR industry, the EV industry, space industry, and a lot of them. So is there one, or do you want to give us a list of 3 or more? We don't mind, that you're looking at and you think that these industries have the highest potential to get the highest returns in the near future?
Sure. If you let me share my screen, I actually have a graphic, or if people are on Twitter, I shared I keep a list of all the industries that could potentially be out there that are disruptive. And I have come up with a list of, let's see.
Yeah, you can share your screen.
90.
I don't know. Can you can share your screen. I think it's
if you make me the host or the co-host, I think I can.
Okay, just give me a second. Let me just allow you to share your screen. Okay. Let me make you the co-host so that you can share your screen easily. Okay. Okay, you are now the co-host.
Okay, great. There we go. Okay. Can you see that?
Yeah.
Okay, I put this image is on Twitter too, if you want to look at it in more detail. But here are the innovations that I have found so far that are up and coming, and they're in various stages of development, but these hold potential to be extremely disruptive in their various industries. Now, I color coded them up top to be who do I think is going to capture most of the value from that technology. This is actually an important concept to understand. If you look back at the last 10 years and just said the growth in solar has been phenomenal. Like the number of solar panels that have been produced in any given year and deployed has grown at like 40% per year. If you believe that, you must be like, wow, solar panel companies must be killing it. They just must be up tremendously over the last 10 years. The truth is that solar panel makers have been a wasteland for investors when it comes to compounding wealth. That's because all of the value that is captured by the solar panels is captured by consumers and society. It's not been captured by the solar panel makers themselves. Because of that, I came up with this little color coding system where I said, here are some innovations. Who do I think is going to benefit the most from the innovations? So the ones in green are the categories that I think investors will capture at least some of the value that's created. The ones in blue and the ones in red, I'm not sure if investors will capture all the value that's created by them. I think they'll be captured by society and by consumers. However, if there's one category that just as a human I'm interested in watching over the next 10 years, it's plant-based meat. The potential, if plant-based meat can realize its potential, that has the opportunity to be more disruptive than the electric car, more disruptive than autonomous driving. Plant-based meat requires like 1/100th the amount of land and 1/500th the amount of water to produce a pound of meat as conventional raising does. This stat that I heard one of my favorite thinkers named Tony Seba said, They recently produced a report, and they said in the United States, if plant-based meat realizes its potential, the amount of land that can be cleared up is equal to that of the Louisiana Purchase, which is about a third the size of the United States. That's how much land could be freed up from people choosing to eat plant-based foods as opposed to cow or chicken or pork produced from animals. The potential disruption, if that is true, is massive. The number of farms that will impact, the impact on the environment, the impact on human health from eating plant-based food instead of meat-based food could just be profound. Is it going to work? Is it going to be adopted? That I don't know. I think it will. And will investors win? Even if it is, that I don't know. But that is a category that I am going to watch very closely over the next 10 years.
Okay, thank you. That's fantastic. Okay, then I want you to quickly, before I kind of do a summary and ask for your last thoughts. We have a lot of people that just started investing before the downturn. So a lot of them are like, I will never invest again in my life. I just lost 80% of my money, 50%. What will you say to somebody that just started investing in the stock market and suddenly it's going down and he's like, it's going to go to zero and he's losing hope? He's like, this is not for me. Am I really supposed to invest? Are stocks even really good for anyone? So what will you say to somebody like that?
First off, I feel your pain. I feel your pain very well. I have bought a lot of bad stocks myself, and I have lost plenty. I have lost a lot of money by buying terrible businesses or even what I thought were great businesses that just did not work out. That is the nature of investing. So I'll say a couple of things. One, you have to know what you own and why you own it. If you can't give me a good reason for why you think the stock that you buy is going to be higher in 5 years and 10 years, you shouldn't own it. Like if you're buying a stock with the thesis is I'm going to sell this in a day, a week, a month, a year, and I'm going to sell it to somebody at a higher price, I'll say, all right, good luck. I think you're gambling. And if you gamble, I have no way of telling if you've made a good decision or a bad decision. And that's thing one. Thing two, you have to understand that markets are volatile. The price that you pay as an investor to earn good long-term returns is short-term volatility. If you bought any stock in March of 2020, it doesn't really matter which stock it was, you're up. Sheer luck, you got in at the bottom and you are up on your investment. If you bought any growth stock, doesn't really matter which one, in February of 2021, you're down. That's just the sheer luck of it. Growth stocks, high growth stocks have been out of favor for the last 2 or 3 months. Neither of those things should inform whether you bought a good company or a bad company. The only thing that you know is that the stock has been volatile since you first launched. So you have to know what you own, why you own it, what factors will make that asset go higher over time, and what factors would cause you to be wrong. So it's really, really hard to do, but you just have to train yourself to ignore the short-term price swings and focus on the underlying thing that you bought. Again, pretend that you bought an apartment complex. You're renting out apartments. You buy this thing for $100,000. If the next day somebody came to you and says, "I'll buy your apartment complex for $50,000," right? Would you sell? No. Would you freak out and say, "Oh, okay, here, you can have it. I'm down 50%." No, you would say, I'm not selling. I know what rents I'm charging. I know this is a good land. I know that I can raise rents over time. I know that I have good tenants. You would focus on those things and you would ignore the price. So you have to take the exact same mindset when it comes to investing. It can be tricky though, because you're seeing these prices move up and down, and it's instantaneous. You can get a price of anything instantaneously. So it's a hard thing to do, but it's the only way I know how to invest well.
Okay, thank you again. Before I get your last thoughts, I would like to say again, we are the World's Hackers. We normally teach people how to invest. So we do normally have a podcast show that happens daily, 7 p.m. GMT, where we just talk to people, find out how they're investing and try to tell them, advise them on things to do. And then we do this every day on our Twitter Spaces, on our Twitter handle. And then on weekends, we do it on YouTube Live. That's 8 o'clock to 9 o'clock. all in GMT, because I had a little trouble converting the time. So I think I got better with that after converting it. Okay. So I just hope that you can join us someday on the podcast, maybe share a few words with us. A lot of guys in the community would like to hear from you, because normally when we're on Twitter Spaces, we're also on Telegram Live. We're like merging everything together so that a lot of, we're like increasing the number of audiences we get. So having said that, please, what are your final thoughts, and what do you think, if I'm a new person that just came to the market, I'm wondering, am I supposed to invest in gold, ETF? What is going to happen in the next 10 years? What am I supposed to do? What are your final thoughts?
Yeah, my number one suggestion there is to educate yourself. Focus on self-education. For myself, I mean, investors that are getting started today are incredibly lucky. Incredibly lucky. There are so many wonderful free resources that are out there on YouTube. There are podcasts, there are blogs, there are wonderful, smart, helpful people on social media, on Twitter, on Instagram, that do nothing but share practical information that for investors to learn what they're doing. That's what you should be focused on if you're new, is educating yourself as much as possible, so that when you are putting your capital at risk, you are doing so from a position of understanding and knowledge, and not from a position of fear. If you don't know what you own and why you own it, it's very easy to get freaked out when stocks will fall 5%, 10%, 20%. So step one is always to educate yourself. I know I'm going to feel like a homer here, but I myself learned a tremendous amount of investing through the Motley Fool. I was a paying subscriber for years before I became a contractor there, and the Motley Fool has lots of free resources for investors to digest. They have podcasts, YouTube videos, all that kind of stuff. So take advantage of that to really educate yourself. That's step one.
All right, thank you very much. I don't see any questions on the chat. That means everybody is okay with all you did. You did a splendid job. Thank you very much for agreeing to speak to us. This video will be sent to the guys in the group that couldn't be here with us now. Thank you very much, and I hope to speak to you sometime soon.
Thank you. Thanks for having me, Chubby. Appreciate it. Bye.
Okay.